Hi, this is Randy Finney with the right side of the chart, and this is a midday market update for Tuesday, April 2nd, 2019. Really nothing new on the broad markets to cover since yesterday. SPY is flat today, but I figured I'd do an update, share my thoughts on that, and just go over a few different things that stand out, a couple sectors, maybe a few trading ops. I won't go all over the place like yesterday's video. That was too much, where I covered commodities, individual trade ideas, the broad market. Keep this one a little more streamlined. Just a quick recap. This is the S&P 500 on a monthly chart, monthly time frame, and that's what's still driving the bigger picture for me, and that is this goes back to the early to mid 90s here. We had a bull market. It was an uptrend line, well defined. A negative divergence, which you don't see often on the monthly charts, and they almost always play out for a major trend reversal, which means a bear market when you're dealing with the monthly charts. So you see all your divergences. We had one here, divergent high, and that was a big correction, about an 18-month sideways market back then, at least a good 18 months, maybe 2 years from this point to that point. And then so this is the most recent divergent high right there we had, and the big correction that came in Q4. And then you also took out this bull market uptrend line here. So that again is really the bigger picture. We zoom in tight, you can see a bull market uptrend line capturing most of the reactions here, especially the bodies, letting a few wicks go through, breakdown, and still a back test. So this one can go either way. Maybe that will prove to be the drop that we had in the fourth quarter, something more along the lines of what we had back here in 2015, 2016, or again, maybe it will be simply a breakdown and a back test of this primary trend line, and a lot more to come. Time will tell. So I continue to focus on this weekly chart right now, SPY. Again, I'm not going to beat a dead horse, but it is the same story for the last 6 weeks, so I have to keep telling it until it's resolved. 1, 2, 3, 4, 5, now 6 candles. Yes, this one is up quite a way above that. We call it I call it the 282-ish level. Runs down from about 281 to 283 or so, but it is significant resistance. And again, remember, we were quite a bit above it week before last after the FOMC meeting, and that's about exactly where we are today. You can see as I put the crosshairs on that high from that was, I think it was Thursday, March 21st. We're trading exactly there, and that's the level I'm still watching. So take it down one more time frame, go to a daily chart, we zoom in, and there it is. So there's that high was at about 285.18. Again, on a almost $300 share price, we're at 285.56 now. So for all intents and purposes, we're still there. So like I said, you have to give yesterday to the bulls. As bullish price action. It was low volume, but again, price comes first, volume's a distant second. So you have that. But so far today, you have a lack of follow through. In fact, the market's flat, slightly down. I'm not going to make a big deal of that, but we're on that level. So, the bulls want to really take out these divergences that are still very much intact right now, the negative divergences, and want to run this market and take out the previous all-time highs right here. They're not too far away. This is their week to do it. I can tell you this, if they fail it again and we come back down this week to below that purple line, especially if for some reason we close a week down below 277.53, that would be a get out of Dodge moment. So let me give you my thoughts. As far as trading opportunities, yesterday was what I'm going to call Black Monday. I don't think I've ever in the 7 years of doing this site now, going on 6.5, almost 7 years. Never do I recall 3 trades stopped out in a single day, and if it has happened before, I can tell you it didn't happen when we had so few trades. Trade ideas, at least the official ones, are as light as they've been, and that again is a function of this 6 weeks of sideways choppy trading. This is not conducive to swing trading, whether you're long or short. If you were long for the last 6 weeks, there were 2 pretty good corrections in there that probably ran your stops, and if you've been short, we had a couple, 3 of them yesterday that were stopped out. 2 just barely, SOXX, I'll get to that in a second, and the QQQ. and they were all very highly correlated with the broad markets. In fact, one of them, QQQ, is it's not the broad market, but it's the Nasdaq 100. It'll track close to the SPY. Obviously, semiconductors are a big component of the tech-heavy QQQ, and then Boeing is a top component of the Dow, and I believe the S&P 500. So those got taken out. And that's it. So we still have, nothing's changed in the technicals, but again, the onus right now is on the bulls to take this up and run, or for the bears to come in and smack that down, make it a failed test of that high from Thursday the 21st. So until that happens, it's more of the same. At this point in time, if you're betting, it should be just like taking a bet in a football game in the third or fourth quarter. If a team is up by 2 touchdowns or more, obviously they're the favored at that point in time in the game, and but anything can happen if there's enough time on the clock. So that's the way I'm looking at this right now. This goes to the bulls, but again, I'm not trying to read too much into it. And so what I wanted to let you know is my strategy will be, if they take this out, it does not change the fact, if we go a little higher here, that we still have divergences forming, big negative divergences on the daily time frame. We have a lot of stocks overbought, and therefore, plain and simply, the risk reward is not any better now than it was 3, 4, 5, 6 weeks ago. It's still not very favorable. Even if they pop it at new highs, you're talking 2.5%, and maybe they run it above that. Maybe they don't even take out the highs. But again, it's about risk reward. So I'm going to, if we close the week to the upside, I will most likely shy away from individual trade setups, stocks and sectors that have a very high correlation to the broad market, and focus on those that don't. So I'll give you a few of those today, talk on some of those trade ideas. And before we do that, let's just wrap up with the 60-minute charts. Here's SPY on the 60-minute time frame. If you look down below, you can still see the divergence just hanging on by a thread. The PPO is starting to roll over right now, meaning turn down, but it hasn't made a bearish cross. So really, where we're at from a technical perspective, we're pushing the upper limits. We're essentially testing that high from the day after the FOMC meeting on the 21st, and we have negative divergence here on the 60-minute chart. So here's the thing: it's either going to get burned through, meaning we turn up, and then soon we take out the previous highs on the RSI and the MACD or whatever other indicators you're looking at, the PPO, and then we no longer have divergence. That's what I call negating the divergence, or taking it out. So that is one possibility, and that would certainly further dampen the bearish case and increase the odds that we're going to new highs. But until then, like I said, or like as I like to say, resistance is resistance until unless taken out. So right now, let's see how SPY deals with that level. Oh, going back to the daily chart, I wanted to show you guys something. I added a line here today, 286.77. It's minor resistance, but it's worth mentioning too in case we do pop up intraday. We had several 1, 2, 3 candles here testing it from below. Then we took it out there on that impulsive candle, came and back tested it right there. We danced on it for 3 days right here, and then finally broke it broke it with conviction with this big red candle there. That helps to validate that as a significant level. It's still a minor level. There's not that many reactions, so we could hit it and go right on through it, but I wanted to make mention that's also a level that we could reverse from if we hit it. And again, that comes in around 286.70. I think I used 286.71 was I believe it was the reaction low right here back on September 7th. Yep, 286.71. So now on the flip side, so if we manage to hold a breakout, especially a solid weekly close up above this level, then what I'll be looking at is, again, a lot of non-index type stuff, things that aren't correlated with the broad markets, because the risk reward just isn't attractive, at least for swing trades. Market, like I can say, can go to the moon without me. If it's not my type of setup, that's fine, I pass. However, the great thing about trading and investing. And there's a whole other world of assets and stocks and sectors and commodities and things out there. You have Bitcoin, you have agriculture commodities, you have oil, natural gas, sectors that have nothing to do with the stock market, such as the cannabis stocks, things like that. So, and that's what we'll look at. Now, if we do somehow manage, at this point, if we manage to turn around and print a red candle and come back down below that purple line again, let's say 282, give or take, especially well below it, that would be pretty darn bearish. That would mean a second failure, that we got that high and couldn't take that level out. If that happens, that would then open the door for, maybe we do finally have a failed breakout. This didn't really prove to be a bull trap last week because there was really no follow through to the downside. But if we get it again, and again, guys, it's just an if, and you have to put lower probabilities right now at this point in time that it's going to happen. So if it happens, then we'll react. And then what I wanted to say to that is, at that point, broad market type ETFs, because then you probably get more broad-based selling when they come in, they sell the index funds, the index ETFs, and everything tends to go down, especially things that are correlated with the stock market. So then you'd be back on to things like SOXX, the SPY, if that's your thing to trade, the SPY, QQQ, things like that. So that's a big if. We'll just have to wait and see. And then finally, let's go look at that QQQ 60-minute chart here. There it is. We had a divergent high back there, and that led to a little correction. You can see right here. Put in a little divergent low. Remember, we had a divergent high here. And right now, we have a roughly equal high. It's slightly lower, but for all intents and purposes, it's about an equal high there. And you can see we're just, by the skin of our teeth, are clinging on to these negative divergences right here. So this is it. It's where we were yesterday. It's the same story. We're pushing the upper limits of that, that high from last Thursday before last. If we fail here, we're going to confirm the divergences. And so let's just say that this little divergent high gives us a little correction like the previous two that we had from divergent highs. What that does, it has bigger implications. Well, you can see my minimum target be that uptrend line right there on QQQ. But on SPY, more importantly, is if that does play out this week and we get a correction comparable to these two on the previous divergent highs, here's what it does. It brings us back in. And again, I'm just rough estimating those previous two from the divergent highs. It's going to take us back below that 282 level. And therefore will give us that failed breakout. So still an option, but until we see it happen, it's really one you probably don't want to bet on. But if you want to give your stops a little more room on the shorts, if you are short, I still think there's very little. The risk reward is attractive, is what I'm trying to say. So stops not far above yesterday's highs, and at minimum, you're probably looking for a pullback trade to come around and close around that 282-ish level, maybe a little below again. But the potential is there for a lot more if we make a definitive failure here with a big red candle on the weekly chart. Until then, we'll have to see how the week finishes. Okay, so things that don't have, that tend to not move as much as, or aren't very correlated with the broad market. Here, those are the auto part stocks. I covered them in yesterday's video, so I won't go into much detail. But this is what there were 1, 2, 3, a half dozen. So we'll go over those real quick. And again, the point being that they're not as dependent on the broad market. But so this one again, this is BWA setting up in this potential inverse head and shoulders bottoming pattern, which if that breaks out would project. I would tell you, even though the measure target's higher, I would be targeting right here, somewhere around that. Here, let me give you the number, hard line. That's why I wanted to give you targets. About 40, we'll call it 46.50, give or take. That's pretty significant resistance there. And then you also have a downtrend line that comes in here, and that would help. That could be the catalyst too to get us up and through that neckline there for the head and shoulders pattern. We're testing that now, so that's one that I think looks good on the long side. ADNT, I mentioned this one. All of these that I'm going through now I mentioned yesterday. It's following through. We had a divergent low. Bullish divergences confirmed with a bullish PPO crossover right there. Big green candle yesterday, followed through today up another 1%, and just plenty of meat left on the bone if this one's going to play out. I suspect the broad market will have to hold up. These might not be very correlated, highly correlated with the broad market, but it would certainly help to have the tide going with them again instead of against them. CPS, Cooper Standard Holdings, nice breakout yesterday. You see the big green candle through there, following through today. Nothing huge. So, but the point is that the train hasn't left the station on this one. So, you go long. If you didn't go long yesterday, you can go long with a stop somewhat below. And I'll consider these as official trade ideas, maybe some of these, since we're so light right now. I just want to get these out to you and kind of share my thoughts on the market and some of the non-equity, some of the things that are not highly correlated with the broad market like these. All right, there was a couple more. TOWR, big divergent low. And we had a divergent low there, so it's not as if these divergences don't play out. They certainly did, and these are swing trades. So big divergent low, big rally, bigger divergent low, possibly a bigger rally. We'll see. Targets on that one, since I didn't give them to you yesterday, I see a big old gap right there, and that is a natural target around 26. But before we get there, we have to take out this level here. We have a couple reaction lows, so about 23 and 26 roughly. Round numbers, but close enough. All right, and WPRT, the Westport Fuel Systems. Again, this one already broke out of this downtrend line / wedge pattern with a divergent low, and I don't see a lot of it's working its way up, and first target's around $1.83. And finally SUP, this one big strong divergent low. A lot of strong positive divergences there. Big move yesterday. Really probably put a reaction. I should put a level here because we had those reaction highs around 590 or so. But I think this one can work its way up to about $7. Again, if the sector holds up and the market doesn't take a sharp nosedive, because that's the thing. If the market fails here this week, especially as I said, if it goes down below those levels I'm watching, I think the rush for the exits can be a lot faster than anybody expects right now at this point in time, especially with how resilient the market has been. So you don't want to be holding a lot of longs in a broad-based sell-off, even if they don't have a very high correlation, because you can see what happened last fall. This is when that meltdown was going on. Again, you look at just about any stock or sector, and it was going down with the market into the December lows. But that's a broad-based sell-off. So broad-based rallies help lift stocks, broad-based sell-offs, but when the market's kind of grinding and working its way up or down to a certain direction, that doesn't always affect the sectors or stocks that are not top components or components of all at all of the S&P 500. Crude oil. I posted this one in the trading room today. I am very much warming up to a potential swing short on USO and crude. Here's the level, 12.96. We'll call it about $13. Pretty well-defined resistance level. And of course, USO does a pretty good job of tracking crude. It's about as good as any commodity ETN does. Some of them are pretty lousy, especially the ag commodities, but some better than others. Either way, there's some levels you can see. I'm just hitting the reactions on USO that come in around that $13 level. So that's it. And of course, you don't only have us running into resistance, but you have a nice clean wedge forming here. Negative divergence at least there on the PPO, and very overbought on the RSI. Last time we were this overbought on the RSI, we were back here, and that's all she wrote for crude. Of course, you can see the other overbought readings in the past. I'm just hitting them there. Overbought. This was in a strong uptrend, so we stayed overbought for a while, but eventually crude prices, came down sharply. And that's the thing about crude. Once it reverses trend, even if it's a smaller trend within the larger uptrend, the corrections are pretty strong, and so are the rips and dips. So it's a very swing tradable instrument, if you will. And this is what I'm watching. So a failure here, that's where an aggressive short can be put on. Right now, we're at 12.97 as I'm doing the video. I had that line at 12.96. So you could short there with a stop somewhat above, and it should be commensurate with your target. Now, looking at this, I'd say we're coming back. If this plays out, first support will be the uptrend line, bottom of the wedge, but I think we'd go on through that and come on down to 1206. So you're talking about 1 point, on a $13 security. That's a pretty good. That's a pretty good trade. It'd be about 7%. And if we come on down through there, if you're willing to ride out the zigs and the zags, I think we come on back here to about 1154. That's about 11%. So we'll see. That's USO. Let me show you what the 60-minute charts of the futures look like. I should have those. Here we go. I posted this in the trading room as well. This is CL, the crude futures 30-minute chart actually we're looking at here. And so I'm watching this uptrend line. I'm watching this potential unconfirmed because the PPO is pointing higher. But if it turns down soon, it will be confirmed negative divergence. There's your divergence lines. And that gives us this little wedge type pattern. There's your uptrend line. So again, same story. You can get ahead of it because crude is at resistance, at least USO. It offers that objective short entry. And on CL, I'm looking at another monitor right now on a CL daily chart, and I do see some resistance here going back to April, last April. And so there it is. So crude at resistance with divergences. Again, that's your more aggressive entry because it's an uptrend. It's a counter trend trade. And then you can either do an alternative entry or an add-on on a break above the uptrend line. And you have a reaction low right there. That'd be minor support. But I think we work our way down here if that wedge goes to about 60.43. And if probably a reaction there, and ultimately work our way down to that 58.20 level, quite possibly. But right now, this is really what I'm looking at. I'm kind of eyeing that as a pullback trade to about 60.43. Okay, hey, I wanted to loop back to the broad market, but really to talk on the FANG stocks real quick. Now, the broad market's humming along right now, but the big FANG stocks, that's Microsoft, Apple, Amazon, Alphabet, Facebook, they are the top components of the NASDAQ 100 as well as the S&P 500. So what I've done, I've noticed there's some pretty nice and clean uptrend lines on the top holdings in the SPY and QQQ. And again, the trend is up, but I've set price alerts on these, and what I'm looking for, if they all start triggering, if we have a reversal day here soon, a pretty sharp down day, one of those 1% plus days in the market, if it happens soon enough, it would take out these trend lines. And the thing is, if I just had a trend line here on Microsoft, but not any clear uptrends or support levels on the others, I wouldn't really put much into it. But what I've noticed over time, if you see all the top components breaking support at the same time, that's a pretty decent sell signal. So I just wanted to point these out. You can replicate it. You can see this is off the December lows. I'm just going to run through these real quick. Here's Apple, same story. There's a trend line. You just exclude that one little pop, one green candle, we snapped right back up. But it's a very clean trend line. A lot of reactions, a lot if you zoom in close. And so again, I have alerts set on all of these. Maybe we continue on, break it later. It could turn around. It could break any day now. But so again, what I've done is set alerts. If you can replicate the trend lines, you might want to do the same, and that might give you a head start in case there is one of those quick swoon downs that come out of nowhere. Remember, and I posted this yesterday, there's a lot of potentially market-moving economic indicators that are to be released this week. So we have a pretty heavy economic calendar, and that could certainly be the catalyst for some surprise in the markets. There's Amazon. You can see not as many reactions, but still you can draw a trend line there worth watching. Here's Alphabet Class A. There's the trend line. I have to exclude the spike down to lows, but it comes in real clean, captures a lot of reactions there. There's the other share class. There's Facebook. This is a trend line I'd be watching right now, looking to make a divergent high if it pushes up and takes out those previous highs. Intel's pretty far above its trend line, but you go down the line, this is now I think the 7th largest component or 8th in the NASDAQ 100. It's Cisco. And you can see there's a clean up trend line, and this one forms a nice bearish rising wedge. So consider that a trade idea as well. And again, markets are humming along right now, but fewer things are more bearish than a failed breakout. So if the markets can't sustain this level and we reverse this week, The only thing I'm going to say is these will play out very fast, I suspect, a lot faster than most will, you know, can think they will. And what'll happen then, if that is the case, you know, by the time you see, okay, yeah, we have clear bearish breakouts, and you start hearing that everyone else is confirming the breakdown, you're going to be halfway there. You're going to be in no man's land on a lot of these. No man's land is what I call when a stock is between support, which is the trend line, and the next support level, or resistance, support and resistance. In that case, broken support becomes resistance. So on a wedge, you know, you have the objective entry on the breakdown, or if you backtest the wedge, but you don't want to, you know, enter a trade, long or short, halfway between the breakout point or breakdown and the price target. That just it makes it very difficult, because at that point you're likely to get a kickback rally, you know, a little near-term oversold rally. Nothing goes straight down. Looks something like this, and you get caught in that. And what this will do is it'll blow your stop out if you shorted right here. So that's why I like to short here, or sometimes I'll even get in front of a trade, you know, short at the top of a wedge in anticipation of a breakdown, and then that gives you a much even more flexibility on your stop. Okay, let's just wrap it up here with IYR. Now this is a IYR, or the REITs at least, are a component of the S&P 500, but in the video I did last week covering the sectors, you know, if I'm recall correctly, industrials were the most bullish of the sectors I saw, but then utilities and REITs were the two most bearish. And we still don't have a solid sell signal on the REITs yet, but you can see the divergences forming. And as I go through the top components here, here's AMT, just trying to give you an idea. This one's really stretched, you know, very, very overbought, and you had an uptrend line there. A little correction, a little flagging type action, and that bull flag has played out. Here's your flag bull, the bull flag, measured target has certainly been hit, and now this minor uptrend line has been broken with a big, fat, bearish engulfing candle there. So this one, I can tell you right now, despite what's going on in the broad market, this sector is one of the more bearish. So you had a trend line break, sell signal number one, kickback rally, a back test, sell signal number two on the back test, and then that bearish engulfing candle right here. You can see it engulfed almost, what is that, 1, 2, 3, 4, 5, 6 previous candles engulfed in one day, and it's so far a follow through to the downside today. Bearish crossover in the PPO and rolling off extreme overbought levels. So AMT, since you have the bearish engulfing, simple. You short here with a stop not too far above that candle. Top of that candle is about 198. That gives you, you know, a downside of about let's say 2.5%, maybe 3% if you want to give it. Yeah, about 2.5 or so percent. And target would at least be that recent consolidation zone, that flagging area there, and that would be about 7.5, and quite likely more on this one. And again, that's just one. I'm just going through the top holdings in the sector to kind of show you what they look like. There's SPG, Simon Property Group, big mall operator, and that one doesn't stand out as compelling to me. So let's look at another one. CCI, Crown Castle, nice big wedge, negative divergence here as well right now, and you just need a sell signal on a break of that trend line, and I think this one comes all the way back to at least right here, 120, and quite possibly all the way down here to 114.40. But again, the point of this is just kind of rifle through some of these charts in the top holdings and show you what they look like, and you can see a lot have these steep uptrend lines, pretty extended wedge type patterns, divergence. And again, you know, here's the thing: the day I stop, you know, trading divergences and things that play out 9 times out of 10 or more, is the day that I should just hang it up. So right now we've had divergences and they've been building on the broad market. That's why I'm still leaning towards, even though it doesn't look great at this point, I'm still leaning towards a failure here, SPY, of that 282-ish level. You know, I'll just sit back, wait for that to happen before adding official trades. But again, I wanted to point out these. It's just a wash, rinse, repeat thing, like on Well, for example. Divergent high, and that correction was good for a 10+% drop. And now we have the same thing, nice clean wedge pattern. Remember, it's not the divergence itself that's the sell signal, it's the break of the support level. So there's another one. EQR, I could go through all of these. I don't have them all marked up, but the same story on a lot of them. Very extended, overbought, the sector confirmed. So as far as sectors to short, I like this one. If you don't like doing individual stocks, SRS is the 2 times short ETF for the REITs. And there it is right there, and I'll be glad to give you guys targets on that. I'll tell you right now. Let's hold a line there. 223.90 would be my first target. These are old targets back there, obviously. 23.90. Here's your bullish falling wedge, because SRS will just be an inverse of IYR, of course. That's 2 times leverage, but other than that, it's tracking the same sector IYR is. The downtrend line isn't as firm. I could force one there, but I don't want to do that now. Let's just say first target, second target coming in right around there, 24.77-ish, with a possibility of a third target here, and I think a pretty good likelihood actually somewhere in this range. Let's just put it right here to be safe, 25.75. So there's your targets, and they range from where we're at now, about 6%, all the way up to about 14%. We'll call this at this point in time my preferred swing target, and that'd be about almost a 10% gain up to about the 24.77-ish level. All right, let's conclude this one here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.